And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Marianne Bartels of Bank of America and Dave Nadig of ETFs.com. Let's kick it off today with retail getting swept up in the escalating trade tensions again. The popular XRT retail ETF down 7% just this month. 4-month lows today. Higher tariffs are squeezing these big retailers. This coupled with Amazon's dominance and the consumer shift from bricks to clicks has put many big retailers in the gutter. What's the best way to play this space? Dave, we have talked about this many times, but it's pretty simple right now. You had Amazon, and now with the additional tariff costs for these companies importing goods from China, they're all getting squeezed.
Yeah, and I think there are a couple ways to play this if you were trying to catch a bottom here, which, let's be honest, could be tricky. XRT, which is the big famous one in this space, equal weights over 90 holdings, so you're not actually getting very much Amazon or anything else there. Something like RTH, which is the Van Eck equivalent here, market cap weights, the flip side of that is you're getting like 25% Amazon. Top 4 or 5 holdings are almost 50% of that portfolio.
The problem with this whole game here is that there are times when Amazon is outperforming, therefore that market cap weighted one will do better, and other times when there's a little more pressure on retail or Amazon's not doing as well, where you get the opposite effect. So it's difficult to, it's almost like you have to switch in and out to really generate alpha, but no one knows when that's going to happen.
It's definitely one of those themes where you have to have a position. You have to believe certain retailers are going to rebound for certain reasons, whether that's bricks and mortar, large firms like Walmart claiming that they have strength coming out of a trade war, or whether it's just going for a pure retail online play.
Marianne, what do you tell your clients when they ask about retail?
So generally we like the space, but obviously Amazon has really disrupted. We really talk about digital disruption. But then we want to look at the fundamentals and look at consumption and consumer spending. And we just came out with a report today saying that the low-end consumer actually is spending. So the low-end consumers that or retailers that we generally think about, we think will do well because you have, consumption across the board. So this has been a dislocated market for several years. It's probably going to stay a little bit more dislocated, but it doesn't mean that you don't want to be in the space. So we want to take a more diversified approach. We'd rather have broad consumer discretionary exposure and diversify across, not just having retail. And our favorite ETF there would be the iShares, and the ticker symbol is IYC.
That's the consumer discretionary.
They call it consumer services.
Right.
We'd rather have broad than just be very specific.
And that brings in a bunch of retailers in addition to manufacturers of consumer goods.
Exactly.
Yeah.
But yet, Dave, one of my favorite ones in this space is Click, C-L-I-X here. And they have a rather unique, this is ProShares, a very interesting company. They have a rather unique approach to doing this. They're going to go long a basket of online retailers that are 100% revenues online, and they want to short bricks and mortar stores. It's a very unusual way to sort of play it. 100% long, the book's 100% long on retailers, online retailers, and it's got a 50% short on old brick and mortar stores. I think it's a very creative idea. We keep talking about this all the time.
It's classic pairs trading. We learned about this stuff in business school, right? You like Coke versus Pepsi, you go long Coke, you short Pepsi. That's really what this strategy is doing. It's just doing it in the whole space. I think it's a very interesting way to put your money where your mouth is. It gives you a little bit of insurance if the whole retail sector continues to be
The problem I have is that you get this concentrated weighting in the ones that you're long. So you're looking at a quarter of the thing is Amazon here, and 14% you see Alibaba, Shutterfly, Groupon. So you got almost 40% or 2 stocks. That are in this. That's a pretty concentrated
there's no question this is an aggressive play on the space, but having that short component does give you some hope that you can still perform in the strategy even if retailers stay flat or decline a little bit.
Bob, what we really stress, and what's really shocking to most of our clients, is less than 10% of retail sales is actually done online. We see tremendous amount of growth opportunities still online, so I can understand why ProShares would develop a product like this.
Are you recommending? But you still have that broader viewpoint with the IYC. You're not diving into this trade.
We do not follow. We don't follow that ETF. We don't have an opinion. But I think what's important for investors to understand is that the digital period is dramatically changing the retail space. It's changing a lot of spaces, but it's dramatically impacting what's happening in retail.